Hi, I'm Ted Cohan, one of the senior portfolio managers here at Baker Boyer, and this is our monthly market update that we do every month. Today, what I'm going to be talking about is a couple different things, some changes that we're making in a lot of the portfolios, and then also current Fed expectation and what the market has done and why we're making some changes to the portfolios. I'll start with the Fed and kind of market expectations where we are right now. As far as the Fed and all the rate increases they've been doing, market expectations right now moving forward are that they're probably done raising rates, possibly one more. That's assuming that inflation numbers continue to come down as they have been. There's always a wild card. If things change on inflation, they could certainly change their mind and increase. But again, current expectations are that they are either done raising rates, possibly one more, and then most likely a long pause until late 2024. Well, then they'll actually have to probably start cutting rates to spur on the economy. We've also seen a really nice rally in the market over the last month. The market is up, depending on what index I'm looking at, somewhere between 7 and 8%. So a couple of the changes that we've made in the portfolio because of both of these things that have been happening in the market is we have increased in a lot of portfolios the bond exposure by about 2 or 3%. And I say a lot of portfolios because it's not across the board, because everybody has a different investment objective, risk tolerance, so it depends on a case-by-case basis. But in a large portion of our portfolios, again, we've increased the bonds by about 2 or 3%. That has to do, again, with the fact that the Fed is pretty much done, I think, expectations raising rates. And so what we're getting now looking forward is a pretty good yield on current bonds. And then as we get to the end of 2024 and the Fed starts cutting rates, they have an inverse relationship. So I have a current price of bonds, and then I have interest rates. So as interest rates will get cut late 2024, you'll get a little bit of a price appreciation on the bond funds as well. And so you'll get a pretty good total return in the sense that you'll get a good yield and then some price appreciation. So anytime we can take advantage of trying to get a pretty good return on bonds, which also does lower the overall risk of the portfolio, that's something we want to take advantage of. It doesn't mean we don't think the stocks have a good outlook. We still think stocks could do well as well moving forward, but we just wanted to try to de-risk the portfolio and still get a good total return. And then the other change that we made, again, in a lot of portfolios is a couple mutual fund changes. We've had the Cohen & Steers Real Estate Fund and a GMO Resources Fund for a while in the portfolio. We decided to remove those two funds and put those assets into a new fund called the Cohen & Steers Real Assets. What the Real Assets Fund does is it combines what those two funds had, which is real estate, commodities, and natural resources, also adds some infrastructure stocks, and then also a little bit of gold exposure. So we think it's just a better way to kind of have that alternative bucket into your portfolio, and we think that'll do well for the portfolios moving forward. So that wraps up this monthly market update. Again, if you have any questions, please reach out to your advisor or your portfolio manager, and happy to go in more detail. And then we'll be back next month with the next market update. Thank you.